Our view is that, we might see a recession in the United States and some European countries, but probably would be relatively shallow. We are looking at economic and financial market risks, but we're much more concerned about political risks, domestic and international. I won't bore you with the list. Our expectation is that the gold price will average more than $2,000 this year. I won't give you an explicit price, but that's up from about 1950 record average price this year, which is up from 1804 record price last year. So we are, we've been saying for some time that we thought that the gold price would rise sharply into 2024, 2025, primarily because of economic and financial and political risks.
Jeff Christian, managing partner of the CPM Group, joins us today to talk about his outlook for the commodities in 2024. We'll be talking about gold, silver, uranium, and oil. But first, a message from our sponsor, I Trust Capital. One digital commodity in particular has done very well over the last 4 to 5 weeks or so, and that's Bitcoin. Now, one of the questions I've been getting the most is what to do with my Bitcoin earnings and profits. Well, one thing you could do with your Bitcoin is to store it in an IRA like iTrust. iTrust offers 35 unique crypto assets, including Bitcoin, and it has the lowest trading fees in the crypto IRA space at 1%. It also offers unique tax benefits. So if you're over 18, you want to open a new account with cash or roll over an existing account, simply click on itrust.capital/David in the description down below to learn more and get started. Jeff, always good to see you. Welcome back to the show.
It's good. Excuse me, I have a cold. It's good to see you. It's good to be back on. Happy St. Nicholas Day.
I appreciate you doing this with us despite you feeling a little bit under the weather. You know what's not been under the weather is two of the metals, and I want to start with first gold and uranium, the two yellow metals. Let's start with gold first. Over the weekend, gold spiked up to new all-time highs, didn't stay there for very long. As you know, the next day on Monday, it came back down, erased most of its losses. I don't want to speculate as to why exactly this happened. I'll let you answer that.
Well, it's very easy. I mean, first off, you have to look at it and say, okay, it was gold, silver, platinum, petroleum all rose at that same time, like about 6:15, 6:18 on Sunday night Eastern time. And the S&P futures fell. And what you were looking at was the fact that on Friday at the close, all of those things, all of those four commodities had settled at levels that were buy signals or above buy signals. And the S&P had settled just below a sell signal. So when trading resumed at 6 o'clock on Sunday evening, you had this cascade of computer-generated trades buying gold, silver, platinum, petroleum, and selling the S&P. And, you look at it in 2-minute intervals, and, the first 2 minutes around 6:18, there were about 4,000 gold contracts. And then the next interval was like 2,000, and the next interval was 2,000. And the gold price took out buy signals, and you had this cascading of computer-generated buys, probably hundreds, if not thousands, of computers saying, hey, this is a buy. So it was a technically driven thing. It lasted for 20 minutes. I mean, the price rose $54 to $2,152. It stayed above 2,100 for about 20 minutes, and then it fell. And then, as you said, over the course of Monday trading, it dropped $130 from that peak. So it was primarily program trading.
Program trading reacting to what exactly, Jeff?
Well, it was reaction primarily to the fact that the prices had settled above buy signals on Friday. There were a couple of attenuating circumstances that probably contributed to it. One was that the Fed chairman, Jerome Powell, said on Friday, hey, these markets are way too enthusiastic. The stock market and other financial markets are building in expectations of larger interest rate cuts sooner than are likely to occur. So that was a sell signal for stocks, and it was also sort of a buy signal for commodities as the obverse of that. The second thing was that on Sunday, you had a U.S. frigate in the Red Sea shoot down some missiles that Houthi rebels had shot off from Yemen. And that raised the prospect in a lot of people's minds that, Iran, with the backing of China and Russia, or the encouragement of Russia and China, Iran is trying to suck the U.S. into a Middle Eastern conflict that's bigger than it already is, so that there could be a second war that the U.S. was involved in addition to Ukraine, supplying Ukraine. And that triangulates the issues with China and Taiwan. So you had these two extenuating circumstances that caused some fundamentally driven investors to come into the market. But you have to understand that probably 98% of the people who buy and sell gold futures do it on technical bases and not on fundamentals or economics or political developments.
Right. Just on the attack by the Houthis now, geopolitical risk premia is what gold has responded to several times in the past. The war in Ukraine, for example, when the Russian forces invaded Ukraine in February 2022, we know what happened to gold shortly after. It didn't stay there. My point is, it didn't stay there. So does gold typically not maintain its geopolitical risk premium for an extended period of time?
It depends on the geopolitical risk. I remember back in like 1982, people were shocked that when Argentina attacked the Falkland Islands, gold price didn't respond. And our comment at the time was, well, there's not a lot of gold bought and sold in the Falkland Islands. It's just not important. I think that, when you see things, and first off, let's talk about Ukraine. Yeah, the Ukraine war occurred and started at a time when gold prices had already risen sharply from the middle of 2019 into the beginning of 2022. So the political risk came on top of a lot of other factors that were already driving gold prices higher. And it's a much bigger one because this is a major battle between the West and Russia. And it's a battle for really the role of Russia in the world, politically and economically and socially. So it's a much bigger one. And that's been maintained. But the idea of the U.S. fighting the Houthi, that's less important and it's less likely to be significant. So you hear the news and your first reaction is gold's going to go up. The second reaction is this probably isn't that critical. So let me liquidate that gold position I just put on.
Regardless of whether or not it's a critical, long-lasting issue, gold is now above $2,000 an ounce. Jeff, would it be fair for an investor to look at the geopolitical tensions around the world and say, well, there's a lot happening right now. We don't know what's going to escalate or what's not. Why don't we just buy gold as insurance? Maybe it'll spike another $100 on news that is unforeseen. Who knows? Is that a sound strategy right now?
It's a strategy we've been telling our clients for years, and
Okay.
with increased emphasis. And over the course of 2023, we have been saying that political risk, both domestic in various countries, including the United States and Canada, and international political risk, is going to probably be a more important factor stimulating investor buying of gold and higher prices in 2024 than will be economic ones. But I want to point out, look, gold's been above $2,000 since the middle of October. And if you look at the gold price, say from January through August, the price was above $2,000. So, we've been saying for some time that the gold price was probably going to average about 1950 this year, and it's going to come in around 1950, and that the gold price will probably average over $2,000 in 2024. And the main factor that we've been citing is political risk. Not so much the U.S. fighting the Houthi, but the election in the United States and the risks to democracy, not only in the United States, but around the world. You've seen an increase toward dictatorial and autocratic governments and changes of laws restricting people's ability to do things they want to do around the world. From China to Russia to parts of Europe, Latin America, Africa, the United States. And that's a real issue that's causing people to say, I should have more of my wealth in gold and silver.
Do you think China will escalate tensions in the Taiwan Strait before the 2024 elections? I've heard this as a theory that they could do something just to test U.S. resolve. Is that in the cards?
It's a very low probability in our view. China actually, within China, there's increased tensions. And there are a lot of people who are very high level in the Chinese Communist Party who have lost a lot of money because of China's increased hostile and militaristic reactions to US and European hostilities. And China, you have seen signs that the Chinese government would like to back away from that because it's hurt their exports and it's hurt their economy in a very significant way. And so you've seen that China actually seems to want to take a more conciliatory approach toward the US, but the US really hasn't done that. I mean, the Biden administration has been very belligerent toward the Chinese, and the Chinese are trying to back away from that because it's really costing them economically, and they don't want to do that. So because that's the dynamics within the Chinese government, we don't think that you would necessarily see them saber rattling in advance of the US election, except that if you see Trump and Biden or whoever it is that's running for president, and there's this race toward downward, like, I can be more belligerent toward China than you can. Oh, we're going to put US troops in Taiwan. Then the Chinese might try to do that. But the Chinese impetus is to try to back away from the hostilities at this point because it's cost them so much money.
Right. Just going back to gold, help me understand the fundamental perception towards gold as a safe haven asset. So when you have a war breakout, for example, we just highlighted several examples that have caused gold to spike even momentarily. But when there is, let's say, a fire sale in the equity markets, gold's one of the first things to sell off along with stocks because people need to raise money and gold is seen as a cash equivalent. Help me understand this dichotomy here.
Well, that's a weird psychology that I don't buy. I mean, let's say that you're an investor and you have stocks and you have gold, and your stocks, you have on a leveraged basis with a broker account, and the price starts falling and your broker says you have to add money to your account. So you take an asset, gold, which is doing well and is there as a wealth preservation tool in this kind of environment, and you sell it to support and retain your dog investments. That's like, no, sell the dog investments. Say, I'm sorry, I'm just going to liquidate my positions here and I'll rebuild them when the equity markets stabilize. You're using your good assets, gold, to retain your assets that are losing money. It's bad psychology. I know it happens all the time. We watch it. Time after time, when the equity market gets into a bind, you see people and institutions do that, but it honestly doesn't make sense to me.
Okay, but it still happens, right? I mean, regardless of the logic, But
Right.
why is it that people rush to gold for safety? I mean, it's a very basic question, but let's help us understand it. When there's fear around the world, what is the fundamental value proposition of gold in light of this fear? Why not rush to treasuries or the US dollar, or I don't know, the Swiss franc, or literally anything else that's safe?
Those are the four assets that people rush to: gold, the US dollar, US treasuries, and to a lesser extent, the Swiss franc. Swiss franc has a problem because it doesn't have enough liquidity for a lot of people. But, gold and US treasuries are the two things that people rush to. And depending on the nature of the crisis, you might rush to treasuries, but not gold. You might rush to gold, but not treasuries, or you might rush to both of them. And what we've been seeing over the last several months, people are rushing to treasuries and to gold. And, we make the point, people focus on treasuries. They, the treasury market's going to collapse. No one wants treasuries, all of which is nonsense. People are buying more treasuries now than ever before. And they're doing that because the treasury is the least risky securities debt instrument in a world where you have total world debt is more than 3 times total world GDP. And most of that debt is not treasury debt. Most of that debt has much more credit risk than treasuries, right? The US Treasury is sitting here with $32, $33 trillion of debt. and its debt to GDP ratio is down around 120, which is where it was in 1947. And so you're saying, okay, you got 120% leverage there in treasuries, which are the least risky debt security. And that's in a world where you have 300% debt to GDP ratio with a lot more risky stuff. So what you're seeing are people rushing to treasuries and rushing to gold. Gold is gold because gold is attractive because it's no one else's liability. It doesn't necessarily have a currency risk attached to it. You know, you don't have to worry about, there have been places and times, including major European economies in the 1930s and 1940s, where the currencies have just turned to dust. So you've never had gold turn to dust. It's always saleable. You might not like the price that you can get for it, but it's always an asset that you can sell, as opposed to, I mean, I've got a Tsarist Russian 5 ruble note backed by gold hanging on my wall. You know, it's worth it. Actually, it's
Where did you get? Wait a minute. Where did you get that?
My brother gave it to me.
Oh, I see.
But yeah, it's from pre-Soviet Revolution, Tsarist 5 ruble gold-backed note, and it's actually worth more than 5 rubles now, because it's a collector's item.
Yeah, for sure. I bet it's worth a lot more than 5 rubles. Okay, thank you for summing that up, Jeff. Sum up your geopolitical and macro outlook and tie that into gold. What is your outlook for gold for 2024?
Yeah, our view is that, you know, we might see a recession in the United States and some European countries, but probably would be relatively shallow. We are looking at economic and financial market risks, but we're much more concerned about political risks, domestic and international. I won't bore you with the list. Our expectation is that the gold price will average more than $2,000 this year. I won't give you an explicit price, but you know, that's up from about 1950 record average price this year, which is up from 1804 record price last year. So we are, you know, we've been saying for some time that we thought that the gold price would rise sharply into 2024, 2025, primarily because of economic and financial and political risks. And that's exactly what's happening. So we expect the gold price to rise sharply over the course of next year, and probably into 2025.
Okay, you don't have to give a specific price forecast, but when you say rise sharply, I'm assuming you mean above new all-time highs, given that it's already above $2,000, right?
Exactly.
Okay. If you're expecting gold to rise sharply, is that also, are you assuming then the real interest rate will decline sharply?
Yes.
Okay.
I mean, the real interest rate right now, depending on how you measure it, is about 2.5%, you know, depending on which inflation number you look at and which maturity you look at, but looking at T-bills. And our expectation is that by the end of the year, nominal rates could be down to 4.5% for the Fed funds rate, and 91-day Treasury bills, and inflation could be around 3% or 2.5%. That gives you a real rate of 0.5% to 1% or so. And at that level, investors are not going to say, oh, I can lock in 1% real returns on treasuries. I don't need gold. They're going to say, you know, if you look at it historically, investors start saying, I don't need gold. I can just invest in treasuries when real T-bill rates are 3% or higher. We don't see 3%. If you've got 3% inflation and 3% and 4% nominal rates, you know, you're talking about what, 6 or 7% nominal rates to get to 3%. We don't see that happening for several years. So we think that the real rates and nominal rates will remain supportive of investor interest in gold for the foreseeable future.
Do you see a scenario in which the nominal rate stays elevated, perhaps even go up to back up to 5%? I'm talking about the 10-year, but inflation continues to come down.
Absolutely. I can see that.
Okay. But in that scenario, the real rate would stay high, right? That would be bad for gold.
Well, the real rates would stay high, but you know, if inflation, let's be optimistic, say inflation goes to 2% and 10 years go to 5%, that's a real rate of 3%. That's a real return of 3% on a 10-year note. You're going to say, so you're going to be an investor and you're going to say, oh, I can lock in 3% real returns for 10 years. Let's do that. No, you're not. Yeah, that's why I was talking about T-bills, and frankly, T-bills are the more volatile place. And actually, T-bills have been higher than 10 years for most of this year. So if you're looking at T-bills going down to, let's say T-bills at 5% and inflation at 2%, then you've got a 3% real rate. That's an orange flashing light for gold investors. If you have a 3% real rate on the short end of treasuries. If you have more than 3%, that's a red light. And if you have 2% or less, 2.5% or less, that's a green light for gold investors.
I want to come back and ask you about silver, the quote unquote, quote, poor man's gold in just a bit. But first, I want to talk about uranium, seemingly defying gravity since, well, June. But really in the last 3 months or so, since September, it's just moved up in a vertical line. Again, I'll start with just a summary of what happened here. So why exactly did it move the way it did?
I think what you're saying, I mean, the uranium market is interesting because most of the uranium is sold in longer term contracts on a principal to principal basis. And so the uranium price that we see, $81 or whatever it is right now, it represents just froth on top of the uranium market. That's really investors and speculators, and it's utilities having to come in and top off their uranium inventories that might not be sufficient under their long-term contracts to meet their demand. So it's a relatively small volume or percentage of the volume of uranium that's actually sold at those market prices. And I think that what you're seeing is a number of reactors in India, in China, and several other countries. There are your reactors that are moving toward completion, and you're starting to see people load up their uranium orders for that. In addition to that, you're seeing loadouts and changeovers at existing uranium at existing reactors. So I think it's kind of relatively a short-term transaction-oriented froth. That said, $75, $80 is sort of the price that you need to justify new uranium mines.
Just on that note, you sent me a table. I'll show it on the screen. A U.S. utility level electricity production. So nuclear as a percentage of total. In 1980, it was 21.6%. In 2022, it's only 18%. I'm not sure what we're trying to highlight here. Is it the fact that nuclear as a percentage of total energy is less significant or becoming less significant?
It's very significant. It's 18% of U.S. Production.
But it's down from 22. Yeah.
If you look at the total amount of electricity being generated and used in the United States, it has risen 264% in that period of time from 1980 to 2022, right? And we have not built a single nuclear reactor in the United States since 1980. There's one that was under construction that has come online, but basically you haven't had any new nuclear reactors built. You have had a number of nuclear reactors that should have reached the end of their useful lives and been closed, but haven't. They've been rejuvenated. They've been re-engineered to be much more effective, to burn uranium at a higher level and higher rate. And as a result, while total electricity production has gone up 264%, nuclear power generation has gone up 200%. 207%, with no addition to capacity. And people look at uranium and they say, well, this was, yesterday's power. But the reality is that there's been a lot of technological changes in the nuclear power industry, and these power plants have been re-engineered. They have new equipment in there that's more powerful and safer, and they're producing more than 2 times as much electricity as they did 42 years ago. Right. And, 18% is a very high level for an industry that hasn't built a new power plant in almost half a century.
With a higher uranium price, though, now it's above 80, right? Yeah, just about 81. Isn't that going to weigh down on the operating costs, or increase the operating costs of these power plants, or is uranium itself not a huge line item?
Again, well, there are several things there. First off, yes, it will have some effect. The second thing is, as I mentioned earlier, a lot of nuclear power plants and power plant operators buy most of their uranium on longer term contracts that don't necessarily rise with that frothy price that
Do you
goes
know
up
if these
and down.
contracts are maturing anytime soon?
They're staggered over time,
Okay.
and as I said, you do have a number of new power plants coming in stream in the Middle East, in India, China, and other parts of the world, and they're going to be needing more uranium, and they're going to be, if they haven't already signed long-term supply contracts there. So the one thing is that the uranium price that you and I see is not necessarily the uranium price that utilities and nuclear power plant operators pay. The second thing is that within that context, the cost of the uranium fuel is relatively smaller. So you have a lot other costs, very high capital costs, very high operating and maintenance costs that reduce the effect on total overall operating efficiency and cost structure and relative to cost structure in the nuclear industry compared to other sources of electricity generating capacity.
How much of the rise in the uranium price over the last 2 years had to do with new investment vehicles around uranium being launched, right? As you know, Sprott launched their uranium trust in 2021. How much of that has played an impact?
Probably maybe 50% of the increase is related to this kind of speculative buying.
Okay. So bottom line, if it's speculative buying, do you expect this momentum to continue for uranium? No. You would take the short side of the bet.
Yeah.
Right?
Well, you can
$81.
look at, Sprott created a Molly fund back in the mid aughties, and their investors lost $300 million in it. Buy high, sell low.
Well, okay. Yeah. I mean, this fund was launched when the spot price was still much lower. All right. On that note, let's move on to silver. I've talked to a lot of silver commentators and miners alike, and that the big debate rages on about silver's fundamentals, whether or not we're still in a deficit, or have ever been in a deficit, or will continue to be in a deficit or a surplus. I know the CPM Group puts out research on this particular issue. You've been reporting a surplus. The World Silver Institute, they've been reporting a deficit. And in fact, they've reported, and this made the news on Reuters, they've reported that the silver, I'll quote this paragraph, the silver market was undersupplied by 237.7 million ounces in 2022. The Institute said in its latest World Silver Survey of 2023, possibly the most significant deficit on record. It said 2022's undersupply and 51.1 million ounce shortfall in 2021 had wiped out cumulative surpluses from the previous decade. That's a very significant report.
Yeah, it's fundamentally flawed. The Silver Institute data, CPM Group measures surpluses and deficits across all commodities as total supply less fabrication demand. You don't include investment demand. And if you look at other markets, you don't see copper in demand, including an investment component. It's just not there. And CPM Group follows, basic economics, total supply less fabrication demand. The Silver Institute, since we walked away from the World Silver Survey in 1994, the Silver Institute has added investment demand to its fabrication demand figures in order to show a tighter market. And it was a conscious decision to have a more bullish view of the market to present to investors. So they have these surpluses because they have these overinflated, by the way, estimates of investment demand. Now, that is the first thing that is a theoretical and methodological problem, because now you're distorting that surplus deficit. But the second thing is, because your deficit, your demand figures in your deficit calculation include investment demand, you're obscuring the fact that investment demand adds to above ground inventories, right? When a fabricator buys silver, they use it. And that silver still exists, but it's in an electronics, or it's in a piece of jewelry, or it's in a mirror or something else. But when an investor buys silver, it stays as silver. It's silver bullion in bar form or coin form. Now, if you have, I don't know what the numbers are, but if you have 450 million ounces deficits in 2021 and 2022, and 450 million or more of that is investment demand. I don't know what their investment demands are for the figures are for those 2 years. That is not a reduction in above ground inventories. That is an addition to above ground inventories. You're not wiping out above ground inventories if the metal is being bought by investors kept in silver bullion form above ground. So there's some methodological errors and some arithmetic errors in their data. The silver market has been in a surplus of total supply relative to fabrication demand since 2005, having had a 15-year deficit prior to that. Of that metal that has been in surplus since 2005, almost all of it has been bought by investors in bullion, refined bullion form, and added to above ground inventories. So you've got 5.5 billion ounces of above ground refined silver bullion inventories, more than 1 billion ounces in coin form, roughly 1 billion ounces in an ETF, maybe 1 billion ounces that's used in working inventories, and maybe another 1 billion ounces that's held in unreported investor inventories. You have 5.5 billion ounces of metal, and the purported deficits of the last 2 years have contributed to the addition of silver to those above ground inventories.
Yeah, they have net physical investment as a demand item at 332.9 million ounces in 2022, net physical. Some of these line items, and I'm sure you're familiar with these as well, like recycling, for example. Isn't this private data? Isn't this not
It's
reported?
all private.
It's not
It's all
private?
Yeah.
I've heard it is. So how is that information obtained?
We have relationships with refiners, smelters, fabricators, and you know, there's all sorts of users and stuff. A lot of these companies are our clients. They buy our research, they buy our consulting time. Others are just friends of CPM Group. You know, we've been collecting this data since the 1970s. Before I took over the research department that cobbles up this data in 1980. But the research department was started in the late 60s. And, you know, if you go fast forward into the 80s, late 80s, early 90s, CPM Group was the only company in the world that was going around the world trying to estimate supply and demand. Mine production's easy because mining companies, if they're public, have a legal and regulatory obligation to report. And they have a financial incentive because they want to encourage investors to buy their company stock. But refiners, smelters, primarily are private. Fabricators, investors are all private. And there's no regulatory obligation, nor is there an economic incentive to report how much you're using in your product or refining from scrap or buying for your own investment. But CPM Group, for more than half a century, our research group has built and maintained really good relations. So you can see things in our data and we can explain, okay, this is why we know that this silver actually was refined in China from concentrates that were mined in Peru or Bolivia or Australia or Indonesia or Papua New Guinea, and then sold to investors in a certain Middle Eastern country. And we know that because we worked with the miners, we worked with the Chinese refiners, and we worked with the investors in that country. So you have to have these kinds of relationships. And if you don't, you're going to get it wrong.
We're talking about now demand for silver. You've pointed this out in a silver commentary, I believe. The usage of silver in industrial properties like missiles, applications rather, industrial applications like missiles. Certainly, with the heightened tensions now in the Middle East and before
Mhm.
the war in Ukraine, people have been wondering whether or not the use case for silver will be propelled because of a need for weapons to be manufactured. Is this true?
Well, it depends. Yeah, it's true, but it's not true. I mean, our estimate is that on a global basis, the military use of silver is probably on the order of 10 or 20 million ounces a year. Uh, but you have these silver promoters who have been jacking up the numbers. So you keep hearing that there's like 480 or 500 million ounces of silver in each Tomahawk missile. And so therefore there's millions of ounces of silver that literally gets obliterated with these missiles. Now, Tomahawks are very large missiles, and the U.S. government keeps it as a state secret, top secret, military secret, how much silver is used in those. But it's not 482. Informed sources say it's probably closer to 10 or 15 ounces per Tomahawk. It's used in solder, in the circuitry, and it's used in an ignition battery to set off the liquid or solid fuel, depending on which missile it is. So a Tomahawk, missile might use 15 ounces, not 500 ounces. Then you say, okay, but those are big missiles. The world has used 2,300 Tomahawk missiles since they were created in 1983. That comes out, if you use the 500 ounces, it comes out to 1 million ounces that were used and lost, not tens of millions of ounces, 1 million ounces. If you look at the U.S. stockpile, military stockpile of Tomahawks, we have about 4,000 of them. That would be 2 million ounces. There's probably another 4,000 that other countries hold. So you're talking about 1, 2, 3 million ounces at that level, but that's not the level. It's 15 ounces. And at 15 ounces, we've used 32,000 ounces of silver in Tomahawk missiles that have been shot off in the last 40 years. And the U.S. stockpile has 60,000 ounces, and other people probably have 60,000 ounces. You're talking about a couple 100,000 ounces.
Okay,
Yeah.
so probably
Now,
not the most significant source of silver usage
right.
from the industrial side. What is going to be a more significant industrial application of silver?
Solar power. Solar power is going to be big. But again, there's these wildly outrageous, overly enthusiastic things. I mean, solar power is probably using about 130 million ounces this year. And it's going to rise over the next 10, 20 years. But it's not getting up to 500,000 ounces the way silver promoters and conspiracy theorists and other crazies think. It's going to rise to 250 million ounces or so. It might rival photographic use at its peak in the mid 90s by 2040.
China is currently the world's largest producer of solar panels globally. Where are they getting their silver from? Is it domestic mines in China? Are they buying mines abroad? Are we gonna see a huge Chinese wave of consolidation or a vertical integration of silver across the globe?
Yeah, well, down the street from you is Silver Corp, and they own a silver mine in China, and it's a very large, very profitable mine. It actually has byproduct lead and zinc, although if you look at it, you could say it's a lead and zinc mine with byproduct silver. The Chinese silver sources are domestic production, which is enormous, imported ores and concentrates, primarily concentrates. They import concentrates, as I said, Australia, Indonesia, Papua New Guinea, Bolivia, Peru. They import copper, lead, and zinc concentrates from all those countries and other countries, and then they refine it. They use the lead, they use the zinc, they use the copper, and then they have this excess silver. So there's imported concentrates, there's domestic mine production, and then there's a very large scrap industry because they have been using silver in a variety of products for a number of years.
So you said that gold is likely to spike dramatically next year. Can you say the same for silver?
Yes,
Okay.
we're looking at record gold prices. We're looking at silver prices over the next 2-3 years getting close on an annual average basis to record levels.
You mean $50 an ounce?
No, the average price of silver peaked at $36 an ounce in
Oh, I see. Okay.
2021.
Okay.
You got to look at the average or the peak, and the peak.
Wait, sorry. Why are we ignoring the peak for this particular calculation?
We don't necessarily ignore the peak, but if you're going to be projecting prices,
Mhm.
you're going to project annual prices or quarterly prices. We project
Mhm.
quarterly prices out 2 years. We project annual silver prices out 10 years. We project annual platinum group metal prices out to 2050, 27 years right now. But if you're making long dated projections, you're
Yeah.
going to be projecting average prices, because that's actually what's important to miners and users and others. If you're trying to pick the peak, the price silver almost hit $50 in 1980. The average price that year was $20. The price almost, I got 2 cents shy of $50 in 2011, and the average annual price was about $36.
Okay. I see.
If you're doing economic research as opposed to pissing in the wind,
Yeah.
for want of a better word, if you're doing real economic work, you're going to be projecting annual prices.
I have one final question about silver, and then I want to move on to oil and finish off there. Why is it that silver has trailed off from $50 an ounce in 2011, like you just said, whereas gold has, over the last 10 to 12 years, stayed relatively flat? I'm not talking about the trough and the recovery. I'm talking about just on a 10-year basis. Gold is back above $2,000 an ounce. Silver is nowhere near 50. Why is that?
Okay. Well, I guess there's two big reasons. And again, you should think in annual averages as opposed to peaks, but we can talk about peaks.
Yeah.
Gold is seen more universally by more people in the world as that safe haven financial asset, that hedge against currencies and stock markets and interest rates and political problems and military incursions. Gold is much more universally accepted as the asset that you want to have a portion of your wealth in strenuous times. Silver is seen that way in a number of places, but in a number of other countries, it's not, right? So gold prices have been stronger because gold is seen more as that financial asset that hedges you against all those kinds of uncertainties. Silver is less so. Plus, silver has really suffered from being oversold by promoters. And you have a lot of investors, I was watching a video on YouTube the other day about, it's very funny because the coin dealers who sell, one of the things you find is people will buy coins and bars from one dealer and sell to another. And they do that because they get a better price buying and they get a better price selling. But what happens then is that allows the promotionally oriented companies that are selling the silver coins to say, we're selling enormous amounts of coins and we're not seeing resales. But you talk to the other coin dealers and they say, we are overloaded with silver eagles and silver maple leafs that people are selling. And you talk to pawn shops and these investors are getting better prices for their silver eagles at pawn shops than they are from the companies from which they bought their silver eagles originally. So we're seeing a reflow. And when you start asking, why are people selling their silver? It's because the price hasn't gone to $70 or $50 or $750. And there's a lot of disenchanted investors. And there's a lot of children whose parents were silver investors and have died. And the children say, sell this stuff.
I haven't heard $750 yet.
Oh, come on. There's a guy that lives in your town. It's been kind of quiet lately, but last year he was assuring investors that silver would be $750. He kept talking about triple digit silver, triple digit silver, triple digit silver. Give me some more vodka. There's a guy in your town who was heavily promoting $750 silver. He's kind of quiet these days.
Okay, I haven't. There's a lot of people in my town. Okay, so Jeff, I want to talk about oil. So, volatile year for oil. Have you been following this market? Okay, I'll let you comment on the supply and demand fundamentals. You're talking about a recession next year that may weigh down demand, but we know OPEC is cutting. So, how's this going to play out?
It's interesting because OPEC is a lot less important than it used to be,
Right.
even with the OPEC plus one, with Russia tied in. The United States is, I guess, now the largest producer of petroleum. And there are a number of other countries. In addition to that, within OPEC, you have a number of countries that are suffering economically. And while OPEC may say these are our quotas, there has always been a very high level of non-compliance with those quotas on the part of oil producing OPEC members. So you have a very well supplied oil market. It's pretty much in balance now. You've seen inventories rise in a number of markets, which suggests some weakening in demand for oil relative to supply. And then, as you said, if we're right and we see slower growth next year, or maybe overt, outright, mathematically calculated recessions, you're going to see a further reduction. You're also seeing a reduction in oil consumption. I mean, you have 13% of the light duty vehicles now being sold in the world not using oil. They're electric vehicles. So you have reductions in unit demand, unit consumption for oil. You have reductions in the number of outlets that use oil. You have increased production. Oil at $70 is very profitable for most producers to pump. At $30, you start seeing, well, even at $50, you start seeing some of the producers not making money. But at $70, $80, $90, which has been the range for the last several months at least, almost all oil producers are profitable at that level. Some of them suffered with lower prices a while back, and they're playing catch up on their revenue.
Okay, so putting all this together, Jeff, of the commodities that we talked about today and perhaps other ones, so we spoke about uranium, gold, silver, and now oil, which of these and perhaps something else we haven't talked about do you think will perform the best in 2024?
I think gold and silver perform the best. I think uranium, again, it's this weird market, but I think it could come off in 2024. And I think oil continues to trade in this wide range between, say, $70 and $95.
Excellent. So you have the daily commentaries, or I think it comes out a couple times a week on YouTube, so people should check
Right.
that out. But you have a bigger report on your outlook that comes out, I believe, in the spring of every year. Is that correct?
Well, we have our monthly precious metals advisories, which are sort of high end, and they cover gold, silver, platinum, palladium, rhodium. We have a monthly base metals report, which covers the 6 LME metals. Then we have our gold yearbook, silver yearbook, and PGM yearbook, and they get released in March, April, and June each year. So we'll start working on those coming up. And then we have special alerts, and market commentaries. I think you might have mentioned, we're producing today. Today is actually Pearl Harbor Day. It's the 82nd anniversary of the attack on Pearl Harbor. And we're producing a report on silver use in military applications, just to sort of clear the air and get rid of some of these gobbledygook estimates that people are floating around.
Yeah. All right. Well, thank you very much for educating us. We'll put the links to your work in the description down below, so please check out the CPM Group. Thank you very much for your time today, Jeff.
Always appreciate it.
Happy end of the year. We'll speak in the new year soon. Thank you.
Yeah, have a good holiday season.
You as well, and thank you for watching. Don't forget to follow and like this interview, and follow Jeff in links down below.